The stock markets in Canada and the United States have once again hit all-time highs, with the TSX recently closing above 17,000 and the S&P 500 SPX reaching over 6,200 as of July 3rd, 2025. Yet this bullish momentum comes at a time when both countries are grappling with uneven economic performance. Unemployment is ticking higher, household debt is swelling, and consumer confidence remains shaky. This raises a critical question. Why are stock markets continuing to climb while the broader economy appears to lag behind? Is this the beginning of a lasting rally or a setup for a painful correction? This video dives into what's driving the rally, why there's a disconnect between Wall Street and Main Street, and the key risks that could turn this party into a panic. 1. The all-time high snapshot where we are today. Recent market milestones are nothing short of extraordinary. In the United States, the S&P 500 has broken into uncharted territory, closing at 6,279. In Canada, the TSX Composite Index recently closed around 17,034 on July 3, 2025, buoyed by strength in sectors such as energy, financials, and mining. These levels mark historic highs for both markets. These highs reflect strong momentum in equities, underpinned by corporate earnings resilience, market optimism about future rate cuts, and a flood of investor capital into sectors like technology and clean energy. Yet these record levels raise a natural question. How sustainable is this growth, especially against the backdrop of economic fragility? 2. What's driving the rally? A. The AI and tech boom. One of the primary drivers of the rally is the explosive growth in artificial intelligence. Companies like Nvidia, Microsoft, Amazon, and even Canadian firms like Shopify have seen surges in stock prices fueled by optimism around AI's productivity gains and long-term profitability. These companies not only dominate market capitalization, but also act as sentiment leaders. If they go up, the rest of the market often follows. AI is being touted as the next transformative force, akin to the internet in the 1990s or the smartphone in the 2000s. As a result, venture capital, institutional funds, and retail investors alike are pouring money into AI-related stocks and ETFs. B. Rate cut expectations. Another key factor is the expectation of monetary easing. After a prolonged period of interest rate hikes to tame inflation, both the Federal Reserve and the Bank of Canada have paused their hiking cycles. Market consensus suggests rate cuts may arrive later in the year, especially if inflation continues to moderate and job markets soften. Lower rates mean cheaper borrowing costs, increased corporate investment, and better affordability for consumers, an environment generally favorable for equities. C. Corporate earnings resilience. Despite the macroeconomic headwinds, corporate earnings have remained surprisingly resilient. Many companies have streamlined operations post-COVID, enabling them to maintain or even improve margins. Large cap firms in particular have shown an ability to pass on higher costs to consumers without significantly denting demand. D. Liquidity and retail FOMO. Retail investor activity is surging again, buoyed by optimism and the fear of missing out, FOMO. From meme stocks to ETFs, retail traders are betting big on a continued rally. Add in high liquidity from cash-rich institutions and corporate buybacks, and the market has ample fuel for its upward march. 3. The disconnect, markets versus the economy. Despite market euphoria, the broader economy tells a more subdued story. A. Sluggish GDP growth. GDP growth in both Canada and the US has slowed significantly. In Canada, economic growth is hovering near zero, while the US is growing at a modest pace. A slowdown in consumer spending and investment has dragged down momentum. B. High household debt and inflation. Households are carrying record levels of debt, largely due to over-leveraged real estate investments. Meanwhile, the cost of living remains elevated, particularly for food, energy, and housing. Inflation has moderated but remains above target, especially for services. C. Labor market softness. Unemployment is rising gradually in both countries. Though still low by historical standards, job openings are shrinking, and layoffs in sectors like tech and finance are becoming more common. Wage growth is not keeping up with inflation, leading to diminished real incomes. D. Confidence gap. Consumer sentiment indices in both countries show that people remain worried about their financial futures. High interest rates, unaffordable housing, and geopolitical instability are weighing heavily on consumer psychology. All these points to a major disconnect between what the market is pricing in and what the real economy is experiencing. 4. What could go wrong? Key risks ahead. A. Sticky inflation and central bank missteps. If inflation remains stubborn, particularly in the services sector, central banks may delay rate cuts or even reintroduce hikes. Markets that are priced for easing would react negatively to this shift, likely triggering a correction. B. Geopolitical flashpoints. Tensions in Eastern Europe, the South China Sea, and the Middle East remain potent risks. A sudden escalation involving Taiwan or a broader Middle Eastern conflict could cause global markets to plunge. C. Debt rollover at higher rates. Many companies are facing the need to refinance debt acquired during the low-rate era. These new debts come with higher interest costs, which could lead to reduced capital spending, layoffs, or dividend cuts. D. Housing market strains. The housing market, inflated by years of ultra-low rates and speculative demand, is now facing the reality of higher mortgage renewals. This could stress household budgets and weigh on consumption. E. Tech sector overvaluation. Tech stocks, especially those tied to AI, are trading at lofty valuations. If growth fails to meet sky-high expectations, or if a regulatory crackdown occurs, tech could lead the market into a sharp pullback, just as it did in 2000. F. Policy and trade uncertainty. Two major uncertainties loom large. First, the 90-day pause on additional tariffs is set to expire on July 9, and President Trump has indicated he will not extend the deadline. If tariffs surge, especially on key imports, it could disrupt supply chains and rattle investor confidence. Second, while markets are pricing in rate cuts, the continued strength in employment data may prevent the Federal Reserve from easing anytime soon, not even at the next FOMC meeting or potentially even by September. That mismatch between expectations and reality could deliver a hard jolt to overvalued markets. 5. Will it keep going higher? Markets could keep climbing if rate cuts materialize, inflation cools, and AI delivers real gains. But if any piece of that puzzle falters, this rally may not last. Conclusion: boom or bubble? The market's climb to record highs is driven by a mix of technological optimism, central bank hopes, and surprising earnings resilience. But beneath the surface, significant economic cracks remain. This doesn't necessarily mean a crash is imminent, but it does suggest caution is warranted. History shows us that markets can rally well past the point of reason, only to come down faster than anyone expects. So what's next? The truth is, no one knows for sure, but as an investor, or even an observer, it's crucial to understand both the risks and the reasons behind this rally, because whether this is a boom or a bubble, the consequences will shape the financial world for years to come. Stay diversified, stay informed, and don't let the highs cloud your judgment.